Good evening, everybody. I'm Abhinya Tyagarajan, and I would like to thank you all for gracing our third event by Bodhi, which is the Knowledge Collective of BOD. In our series of Thinking Like a CXO, we have reached a very interesting and relevant topic today, and all of us are here in anticipation to listen and to learn as our guest, Mr. Raman Kumar, enables us to think like a CFO. Mr. Raman possesses extensive experience and deep knowledge in today's subject, and I can only attempt to cover most of it in an introduction. Mr. Raman Kumar is the RVNAF Oliver Professor of Investment Management in the Department of Finance, Insurance and Business Law in the R.B. Pamplin College of Business at Virginia Tech. Like some of us panelists here, he is also an IIM Calcutta alumnus and did his PhD from University of Pittsburgh. He teaches finance and economic courses in undergraduate MBA, executive MBA, and PhD programs at Virginia Tech. His areas of research include asset pricing, derivative securities, financial markets, market microstructure, and empirical research methods in finance, to name a few. He has served as the department head of finance at Virginia Tech and has also served as the director of PhD program in finance and on various university, college, and department committees responsible for curriculum, promotion, and tenure. So, we are eager to learn from your expertise, and over to you. We can commence the session now. And I'll just like to repeat what you mentioned, that as and when questions arise, feel free to type it out in the chat box or maybe raise your hand so that we can promptly unmute you and you can elaborate your question and have a face-to-face interaction with sir. So over to you, sir.
Thank you, Abhina. Now, as you mentioned that after graduating from IIM Calcutta, I worked for 3 years in India, and then decided that the academic world was more interesting to me than the real world. Now, that's not this thing. It's just that I wanted to learn more finance, so came here and did my PhD. And I've been teaching at Virginia Tech now for almost 40 years in the finance department. So even though my area is more on the investment side of finance, that is, what are the right decisions? How do you go about making investment decisions in financial assets like stocks and bonds? However, I've also done enough research papers as well as taught courses in what we call corporate finance. And so that you understand the context of my talk today, the world of finance can be broadly divided into three sort of subfields. One of the three subfields is called corporate finance, and corporate finance has to do with how financial decision-making is made within a non-financial corporation. So the primary business of that company or corporation is not finance. They could be manufacturing cars, they could be manufacturing planes, it could be an airline company, it could be a consulting company, but the product or the service they are engaged in is not finance. However, such companies also need a very strong team of finance executives that manage the finance function and the accounting function within that organization. That part of finance is called corporate finance. The other side of finance is investments, that has to do with how should both individuals and institutions make their financial investments. That is, buying stocks, buying bonds, creating good portfolios of stocks and bonds for the purpose of investing money. And then the third area is financial institutions. How do you manage a firm whose primary product or service is in the finance area, like how do you manage an investment banking operation, commercial banking, or mutual fund? So that area of finance is called financial institutions. The talk today will be primarily from a corporate finance perspective, because the term CFO is typically applied to the person who heads the finance function in a non-finance corporation, where the primary business is not finance, but some other goods or services. So with that introduction, let me start with this with my presentation. And again, please do interrupt at any time. So let me begin by talking about what is the role of a CFO. Actually, the CFO role manages two distinct functions. They are related, but nevertheless, they are very distinct. They're some distinct functions. And the two functions that a CFO manages is the accounting function and the finance function. Now, in smaller business organizations, the CFO may be directly heading the accounting team and the finance team within the company. However, as the size of the company grows, there are two individuals that will report to the CFO. In US, these two individuals, the titles given are typically controller and the treasurer. Controller becomes the head of the accounting function, and treasurer is generally the head of the finance function. So these two individuals both will report to the CFO, and they will one will manage the team that does the accounting, the other will manage the team that does the finance function. But since these are related, these two teams tend to work quite closely together. Now, just so that even though I'm not going to talk about the accounting function, I'm going to primarily focus on the role of a CFO for the finance function. I'm just giving you some bullet points of what the accounting function involves. Obviously, the most important and which is legally required is the financial accounting function, where they record all financial transactions, maintain accounting books, make payments, collect payments, prepare income statement, balance sheet, cash flow statements, etc. Then in addition to what is required, accounting function also does something what we call managerial accounting. That's the additional things the accounting, the team that does accounting will do for the corporation is do any accounting statements that are needed for internal reporting or internal decision making. So for example, cost accounting can be one. What is the cost of this project? What's the cost of producing this item? What's the cost of delivering this service? That's not required by legally by any regulators, but nevertheless, it's a very useful exercise. Then, of course, we can't live without taxes. So there's a team of accountants that will do tax accounting. And then you will have both internal and external auditors to make sure everything is being done correctly. We are going to be more focused today on the finance function, and the finance function has evolved over the years, but currently these are some of the more important things that come under the finance function. I think, and I've put them in order of both importance and how frequently you encounter them. So capital budgeting is the name given to the entire process that the CFO and his or her team engage in to decide whether or not a new investment opportunity makes sense. Is it worthwhile from the shareholders or the owner's perspective? So let us say an airline decides to add flights to another country. Boeing Corporation decides to build a completely new line of planes. Ford Motor Company decides to build a new plant in India. Reliance decides to again expand into a new product or service. These require huge amount of investments, and not for the short term, but for the long term. And the word capital refers to long-term funds. So generally, when I say, I'm sure all of you have heard the phrase money markets. Money market refer to short-term uh, short-term investments, short-term borrowing. All of that is called money market, and capital market is that part of the financial market that deals in long-term funds. So capital budgeting is the process by which the CFO and his or her team will decide whether or not this new investment opportunity makes sense from the owners or the shareholders' perspective. And that's, in my opinion, at least, it's the most logical way to approach for a CFO whether or not to say yes or no to a new investment opportunity. Because ultimately, the CFO is investing the shareholders or the owners' money. And if it does not make sense from the shareholders or the owners' perspective, shareholders will sell the stock and go to another company. So the correct approach for a CFO in making these decisions is to see if the shareholders or the owners benefit from making this investment. So that's going to be the perspective for all the decision making that a CFO does. Most of my talk today will be on capital budgeting. Because each of these topics, we can go on for not just 1 hour, but more than an hour. So we'll have to focus on one topic. So that's the one I'm going to be focusing on today. The next activity is, how do you raise the capital? Where do you get the money to make that big investment? So raising long-term funds for the new investment opportunity also becomes the job of the CFO and his or her team. So they could decide to, if it's an existing company, they could decide to issue more stock. We call that a seasoned equity offering. A seasoned equity offering is when an existing firm decides to sell more shares in the marketplace. So you could do a seasoned equity offering and raise more capital for that investment opportunity. Or you could go to a bank and borrow money. Or you could sell bonds, which is basically you're borrowing from the marketplace. So that's raising capital. That is also handled by the CFO and his or her team. In making that decision whether to borrow money or to issue stock, the underlying objective is to come to an optimal mix of equity and debt. First of all, let me be clear that all of us understand the meaning of equity and debt. Equity represents all the capital that has been provided by the owners or the shareholders of the firm. And debt represents all the money borrowed from any source, all of the capital that has been borrowed from different sources. And there is an optimal mix of debt and equity for any firm. There's no formula for giving you that optimal mix. However, we all know that there is an optimal mix. And what's the tension? Why can't we go 100% equity, or why can't we go 100% debt? Why is there an internal optimal? Basically, in general, debt is cheaper than equity for a firm. The stockholders require a much greater rate of return. The lenders require a much lower interest rate because debt is less risky than equity. Why is debt less risky? You have to first pay your debt holders in case you run into problems, and then the remaining money, if anything, belongs to the shareholders. So shareholders' claims to the company's earnings are riskier than the debt holders claim. And therefore, debt holders are happy with a lower rate of return. Stockholders, because they are taking more risk, want a higher rate of return. In addition, when you make interest payment to debt holders, you get a tax deduction. In the sense, interest payment is considered a tax deductible expense. When you pay returns to the stockholders like dividends, that is not tax deductible. So there's a tax advantage to issuing debt. However, debt, on the other hand, increases the chance that the firm will go bankrupt. The more debt you take, the greater the likelihood that if you hit bad times, you may not be able to pay all the interest. You may not be able to repay the debt. And so it increases the risk of going bankrupt or running into financial trouble. So given this benefit of the cheaper cost of debt and the tax deductibility of interest payment, on the other hand, it increases risk. There's an optimal mix of debt and equity. And it is the job of the CFO and the CFO's team to decide what is the optimal level of debt and equity for each firm. And they consider various factors. So I could spend the next 2 hours talking about what are the factors that go into determining that optimal mix. But today, my today's talk is going to primarily focus, as I said, on capital budgeting. But are there any questions of what do I mean by capital structure? What do I mean by raising capital? And what do I mean by capital budgeting? Okay. Then the next important decision the CFO and the CFO's team makes is once the firm turns profitable and is generating more cash than what it needs to invest in the growth opportunities. So the firm has become highly profitable. It's no longer a startup. It's become a mature firm. It's generating a lot of profits and is generating a lot of cash inflow. But there are other competitors in the space, and the overall industry growth has matured in the sense the industry is no longer growing at 35-40%, but maybe 5-10%. So the cash you're generating every year is way more than what you need for your capital budgeting purposes. That's the time the firm begins to start paying out its profits back to the shareholders. And the payout can come in the form of dividends, or the payout can come in the form of stock buybacks or stock repurchase. And stock buyback repurchase is when the firm goes into the secondary market and starts buying back its own shares. So that's the way it is paying money back to its owners. Now, each of these two mechanisms have pros and cons. There is tax implications of different tax implications of both of these. There is more flexibility to your investors in stock buybacks. The ones who want the money can sell the stock. The ones who do not sell the stock back. In dividends, there is no choice. You pay the dividends to all the stockholders. So again, what are the implications for the investors? What are the implications for the market? What are the implications for the firm? They are very different between these two strategies to make a payout, significant payout. And again, that's another topic that can be a discussion for another day. And then there is the day-to-day working capital management. Do we have enough money to pay the bills as they become due? So we have to pay our suppliers, we have to pay our employees. Do we have enough short-term funds to meet our short-term liabilities? And so how do we manage our short-term situation day to day, week to week, month to month? We are not talking about long-term, but we are talking about short-term financial management. And then once in a while, the CFO team gets involved in mergers and acquisitions. That is, if the firm decides to buy another firm, How do you value the firm? What is the correct price you should be paying for the firm you're looking to buy? Or if another bigger firm wants to buy out your firm, what is the right price you should demand for the entire firm? So in that, the the first exercise the CFO team engages in is how to value the firm. If if another firm is bidding for you, what is the price you should ask? If you're trying to buy out another firm, what is the price you should offer? So you value the entire business and enterprise. That part of the exercise is called valuation. And that is not a day-to-day exercise that happens once in a while, but it's a very complex and very uh, uh, time-consuming exercise. And in fact, several very good textbooks have been written on how that entire exercise could be conducted. And that obviously is a topic I will not be discussing today, but that can be a topic for discussion another time. So this basically slide tells you what are the different things within the finance function that comes under the CFO, under the CFO's management. Any questions?
Yes, sir. We have a question from the audience. Gaurav Goyal is asking us, since you mentioned debt-free, so his question is, what do you mean by debt-free? Because big companies say debt-free even when they have loans from institutions.
Okay. Yeah. So actually, the accounting is a very sort of regulated, rigid exercise where what you can call debt, what you can call equity is all determined by the law and the regulation. Okay. And on the other hand, finance, there is no body out there that's saying, this is how we call we call debt. This is what we call equity. So at times when people move between the two functions, they sort of get confused because one accountant will use one word to describe something and the finance team will use slightly different terminology. So let me explain conceptually what debt is. Okay. Anytime you have a business enterprise has taken money from somebody else and they are not owners of the firm, they are not the shareholders of the firm, for all practical purpose, the finance team calls it a debt because you have to return the money. Shareholders' money you don't have to return. They have invested in the firm and they are going to be owning the firm and they are going to actually want the firm to grow. But debt represents any part of the money the firm has that has to be paid back in a certain time frame. Okay. So for example, you go to a bank and you take a 3-month loan, a finance person will call it a short-term debt. You go to a bank and take a 5-year loan, a finance team will refer to that as a 5-year debt. Only the larger corporations in India do this. They sell bonds. So instead of going to a bank and borrowing money, let us say Reliance Industries recently, I think a few years back, wanted to borrow $4 billion from the marketplace. So it, instead of going to a bank, it sold bonds worth $4 billion. What do I mean by sold bonds? Basically, they took 4 billion, divided it by 1,000 and denominated each bond to be $1,000 bond and sold that many bonds to investors in the marketplace. Institutional investors, mutual funds, insurance companies, pension funds, everybody bid, okay, we will buy $100 million worth of these bonds. Somebody else said, we will buy $150 million worth of these bonds. So these bonds were sold in the market just like stocks are sold. Okay. Those are also called debt. So the debt can take various forms. But as long as it represents borrowed money, we will call it debt within the finance team. Now, accountants have legal definitions, what to call debt, what to call preferred stock, what to call equity. So, because they have to follow the laws and regulations set out by whatever are the guiding accounting principles within that country. Now, have I answered your question, or did I miss the question totally?
Gaurav, you could unmute yourself if you.
Gaurav says yes.
Okay.
Okay.
Sure.
Any other related questions as to what is considered debt for our purpose?
Can I ask a question, Raman sir? Hi, Saurabh.
Sure.
This is Praveen.
Yeah, please go ahead.
So we understand that as an SME, the option which is left majorly for SME in India is debt. And when we talk about equity debt mix, we generally we are not in the position to sell our equity because the valuations are so dicey.
No, could you repeat the question? I didn't.
Yeah, what I'm trying to say is that in SME organizations in India,
Mhm.
to optimize the debt and the equity mix, it's very difficult. Generally, if we do a capital budgeting for a long-term expansion, the only area left is debt only. Either whatever it's maybe bank or it may be any borrowed from near and dear. That's the only way left.
Mhm.
So how do we prepare a capital raising capital structure of debt and equity in a SME
Mhm.
in India?
Can you introduce yourself, please?
I'm Praveen Khandelwal.
Praveen Khandelwal. Okay, Praveen.
Yeah.
Okay. So the financial markets in developing countries are not as liquid or as well developed as they are in, say, the countries that have had a long history of well-functioning financial markets. So if I understand your question, that small enterprises in India have trouble raising equity as they want to expand. So the only option left for them is debt, either for family and friends or from commercial banks. Is that, have I understood your question correctly?
Yes.
Okay. So now, first of all, at least during my visits to India and conversations with both my colleague, my classmates from India and people I interact with India, is that what we refer to as venture capital, angel capital, entrepreneurial capital, it is becoming more and more available, okay, compared to what it was, say, 25, 30 years back. And so I'm wondering, I'd like your answer, is it still very difficult for a startup to access these kind of groups?
No, not exactly very difficult, but most of them are majorly available for tech-based startups.
Okay.
But we as a business owners, we are into a traditional kind of business like manufacturing, distributing product, and then selling. So everyone wants to be into an asset light model and then scale up fast. But whereas an SME, you have to manufacture, distribute, and then again you have to expand. Technology changes, expand. There's always a capital requirement which you need.
Okay.
Yeah. Actually, I could add a bit from the Indian context, Praveen. So there are two options which a lot of SMEs explore today. One is private equity instead of venture capital, which is traditionally, typically more interested in traditional enterprises, provided they have a great opportunity to grow. And the other is, the SME IPO route, which is now becoming quite popular.
As far as we have gone through that understanding SME IPO route long back, and we're still in touch. But they just have a very set kind of an valuation process.
Good point. Yeah, I understand your challenge and problem statement is very real.
Yeah.
But even in US, raising private equity or venture capital for a small startup isn't that easy. The uh, the process which you have to go through to convince the private equity investors is not an easy one, and a overwhelming number of SMEs will not be able to get the funds because they're very, very particular about where they invest and where they don't. And yes, in that case, borrowed money from family and friends and banks has to be there. And ultimately, you may end up taking the level of debt to beyond what is optimal for the long term. But that's the way the situation is. So you live with whatever is the situation. And remember, at least in terms of the rate of return demanded by debt providers, is going to be a lot less than the rate of return demanded by private equity or venture capital investors. They're not going to be happy with a 9, 10, 11% return. So at least you're getting funds at a lower cost. The problem with is the cash flow. The debt holders do not want to wait to collect interest payment till you start turning profitable, while equity investors are willing to wait during the period where the firm is not yet profitable but will eventually turn profitable. So it's not an easy exercise, but that's the situation you have to deal with. That is, you either go private equity, venture capital, or you go to a bank to borrow money, or you go to your family and friends. And hopefully you can convince your family and friends to become shareholders and provide equity and not become lenders. If they have confidence in you, you should be able to convince. If you think you have a good idea, try convincing them to become a part owner. Of course, you'll now have to share a part of your future profits with them. But if you want to grow, that's not a bad idea to invite your family and friends to become part owners of the firm. And you should be willing to share your future profits with them. By then, you are raising equity from family and friends. A lot of startups here I know raised equity from family and friends, not debt from family and friends. Does that answer your question?
Yes, partly yes. Yeah.
Okay.
Thank you.
Any other questions on this slide before I focus the rest of my presentation on capital budgeting?
Yeah, just a quick one, Raman. I am Mukesh here. Is that
Sure.
Another interesting question which keeps on getting discussed here? I do not know whether you can really answer it now or maybe some other time. Is that private equity or venture capital? A lot of times these guys choose the place to invest in based on not the profitability, but purely revenue and customer growth.
Yeah.
Right. So although you do not see when that enterprise will start making profits, it's very not visible in near horizon, but still they get a lot of funding because they are able to grow and get millions of customers, in a very short span of time. So what exactly is behind that decision and how that works?
Okay. So basically, the experience of these private equity investors and venture capital is that the earlier you get in, the greater is the chance that you'll be able to get in at a lower cost to you and a greater return in the future. Once a firm already turns profitable, the founders or the existing shareholders are going to demand a much higher price, right? But when the firm is not yet profitable, the venture capitalists are more in the driver's seat, right? Where are your profits? Who's going to give you money? We are willing to give it. So their rate, as a result, they are able to get in at a much lower price. And if it does turn profitable, the returns can be on an annualized basis, 60, 70, 80% a year. If you wait till a firm turns profitable, you will, so later stage private equity investors will earn 25, 30%. The early stage ones will earn 70, 80%, right?
Yeah.
And so they have learned from experience that if the growth potential of that product or service is huge, right? And right now there are very few competitors. And as we've evolved from low tech to high tech, the economies of scale have become huge. What do I mean by economies of scale? Most of the cost is in R&D. The per unit cost of producing the item is very low, right? So if the firm at which you are providing the funds is in that stage where they are incurring huge R&D expenditure, but the marginal cost, so these people look at what is the marginal cost of producing each additional item relative to what is the R&D cost. So if the R&D cost is in billions, per unit costs is in hundreds, they know that as the market expands, this firm is going to turn highly profitable. Right now, they're making losses because their fixed costs are huge, their marginal costs are small, right? But if sales are growing at 60, 70% a year, very soon, this firm, 2 years, 3 years, 4 years, 5 years, is going to turn profitable. The fact that they are able to sell is a sure sign that the market likes their product or service, correct?
Right.
And so they are forecasting that this firm within a 3 to 5 year period is going to turn highly profitable. And if we don't get in now, so we are getting in, the earlier we get in, the more are going to be our returns if we are right about this company succeeding. So equity investors are getting in earlier and earlier and earlier because they've realized the earlier they get in, obviously they're taking a greater risk.
Yeah.
What if the thing falls flat? But if it doesn't, the higher will be the rate of return. And so you're absolutely right. Those investors are now looking for a higher rate of return by getting in earlier before the firm turns profitable.
Right. Thank you.
Any other questions? And if any of you have a better perspective or an additional perspective than what I've said, please do speak up. I tell my students about close to half of what I've learned or been motivated to learn has come from students' questions. And for people who have been working in the industry, and they add to my knowledge base also. So if you can add to what I'm saying, it'll help me and help everybody else. So the rest of the talk is going to be focused primarily on capital budgeting. And even there, I'm not going to be able to get into all the complexities. But if you do have a question about a particular complexity, I'll be glad to answer it within the time frame that we have. So what do we mean by capital budgeting? It's the process that the CFO's team engages in to decide whether a potential investment opportunity is worthwhile from the owner's or the shareholder's perspective. Which means, does it give a rate of return that's appropriate for that level of risk or not? That's the ultimate objective. And then if it is worthwhile, the CFO's team will say, let's accept that investment opportunity. Otherwise, the CFO team will say, no, this investment opportunity does not make sense, so let's not do it. So we call it the accept-reject decision. So that's the objective of this exercise at times is an accept-reject decision. However, at times the decision is not accept-reject, but to pick which is the best alternative amongst the ones that are presented. And I'll talk a little more about that. We call those investment opportunities mutually exclusive. You're not deciding which all opportunities to accept and which all to reject, but from amongst the set of opportunities, which is the best one. And you will pick only the one that is best. So we call that set a mutually exclusive set of investment opportunities. But we'll get to that question later. Right now, I'm just going to look at the accept reject decision. When we have these investment opportunities, how do we decide for each one whether it's acceptable or not? And that's the purpose. And again, the perspective is the shareholders or the owner's perspective. The 5 commonly used methods for capital budgeting are the payback period, the net present value or the NPV rule, the internal rate of return or the IRR rule, the discounted payback period, and the profitability index. And I'll explain in more detail all of these 5 methods. The first 3 are more important, so I'm going to focus primarily on them. But if there is time available, I'll talk about the discounted payback and the profitability index also. Somebody had a question? So payback period is possibly the oldest method that has been used for capital budgeting, and it's possibly the easiest also. It simply calculates how many years or how long will it take to recover the original investment. So let's look at 2 examples. One is a rather simple example. One is a little more complex example. In this example, let us say there's an investment that costs 50 lakhs. I know these days 50 lakhs is not a major amount, but you can add as many zeros as you want to the example to make it more realistic. And let us say the project is of a kind where you expect to earn a cash flow of 12 lakhs every year for the next 7 years. Now, is everybody familiar here with what do we mean by the word cash flow as opposed to earnings? Or do you want me to explain the difference between what are known as earnings and what are known as cash flows generated by a project? Would anybody like me to clarify the difference between earnings and cash flows?
Yes, sir. It'll be helpful.
Okay. So all of you should be familiar with, or I expect you to be familiar with, a company's profit and loss or income statement. Basically, profit, loss, income statement, you start with the sales revenue and keep subtracting different categories of expenses. If it's a manufacturing firm, manufacturing expenses, salaries, material cost, interest payment. But some of those expenses that you deduct are actually what we call non-cash expenses. Is everybody familiar with the meaning of the term depreciation? Or does anybody want me to explain what do we mean by the word depreciation? Okay, just so that we are all on the same page, any major capital expenditure you make, like buying a piece of equipment for an airline like Vistara, buying a plane, for a firm having cars and trucks for the purpose of carrying on these business. These investments are capital investments, but you cannot treat it as an expense in the year you buy them. So if Vistara buys a new plane, let us say for $50 million or whatever is the cost, they cannot deduct that 50 million as the expense for that year. A certain percentage of that $50 million will be charged as an expense every year. And the part that is charged every year as an expense is called depreciation. Now, depreciation is a non-cash item. You're charging as an expense, but the cash flow occurred when you bought the item, not the amount that you depreciated every year. So basically, the finance team will take the net income generated by the firm every year and will add back all non-cash expenses that were deducted. And they will not include any financial expenses in that, like interest payment. So have anybody of you have heard the phrase EBITDA? If not, let me explain what do we mean by the phrase EBITDA. It's the earnings the firm generated before interest and taxes. So that's why it's called EBIT, earnings before interest and taxes. And then you add back the depreciation and amortization, the non-cash expenses. So a preliminary estimate of a cash flow each year is a number called EBITDA, which is earnings before interest and taxes, and you add back the depreciation and amortization expenses. This becomes the estimate of the cash flow for each year. So whenever you're making an investment, a new investment, let's say in this case it's 50 lakhs, it's going to generate future earnings. And from those future earnings, we'll be able to figure out what are the future cash flows. So the CFO's team will look at what are the earnings that can be attributed to this investment. And using those earnings, can we estimate the cash flow that that investment will generate over the life of that investment? So in a simplistic example, I'm saying, let us say that cash flow is 12 lakhs every year for the next 7 years. And a preliminary estimate of the cash flow is what is going to be the EBITDA that the firm generates as a result of making this investment over the next 7 years. Why 7 years? Different projects have different lifespans. If it's a 7-year investment, if it's a 20-year investment, so you decide how long this investment is going to generate cash flows. And in this example, it is 7 years. And let us say the cash flow associated each of the next 7 years is 12 lakhs with that investment. So payback period will simply be divide the initial investment by the amount of the annual cash flow. So if the cash flow is the same every year, which is not very common, so this is not a realistic example, but if the cash flow happens to be the same every year for the next 7 years, so you simply divide the initial investment by the amount of the annual cash flow, and your answer will be it takes 4.17 years to recover the original investment of 50 lakhs. Does this make sense to you? First of all, do you understand how this payback period is calculated? Now, in the old days, instead of dividing it by cash flow, they would divide it by the earnings per year. But as this capital budgeting has evolved over the years, people have realized it's better to use the cash flow number and not the earnings number. This is the cash outflow when you made the investment. So if that piece of equipment or that plane cost say $5 million or $50 million, take the investment and then divide it by the amount of the annual cash flow generated. So this is the number of years it takes to recover that investment. It's not a very sophisticated method. In fact, I don't like this method, but this has been the oldest method that has been used by the CFOs and their teams to decide whether or not an investment should be made. And each business had a cutoff. If the payback is more than 5 years, we will not make that investment. If the payback is less than 5 years, we'll make that investment. So they calculated the payback. And if the payback for the project was lower than the cutoff, they would say, let's go ahead. If it was higher than the cutoff, they would reject the project. It is not a good method, but it's the oldest method, and some firms continue to use it even today. Any questions? Okay, now let's make the example a little more realistic, where I've just assumed that the investment is the same 50 lakhs, but the cash flows are no longer the same every year. In this example, it was 12 lakhs every year for the next 7 years. So you could simply divide the investment by the annual amount, and that told you how many years. But now, let us say the initial investment is 50 lakhs and the life is still 7 years, but these are the cash flows, projected cash flows over the next 7 years. Now, remember, the CFO's team spends a lot of time and effort in estimating the future cash flows that can be assigned to a given project or a given investment. So basically, what this team does is takes the new investment, and if that investment were to be made, what are going to be our projected income statement for the next 7 years? So they will come up with projected income statement or profit and loss statement for the next 7 years if it's the project has a 7-year life. And from the projected income statement, then they will figure out the projected cash flow. So the first step is to come up with the projected income statement. Then using the projected income statement, they come up with the projected cash flow. Now, if you're going to approach private equity firms, venture capital firms, you will have to engage in this exercise. They will want to see your projected income statement. They'll want to see your projected cash flow statement so that they can decide whether the investments you're making are good investments or not. So this is a necessary exercise. Obviously, it's a forecast, so things will not turn out exactly as forecasted, but you nevertheless have to say, where do you begin to prepare projected income statement? You project by what percentage your sales will grow every year. You have to project by what percentage your expenses will grow every year for the next 7 years. And then you come up with a projected income statement. From the projected income statement, there is a way to figure out the projected cash flow. And these are projected or expected cash inflows. And in this simplistic example, I've just told you, let us say you've gone through that exercise, and these are the projected cash inflows associated with this investment. Any questions so far? So now to come up with a payback period, you take these projected cash flows and incorporate year 0 in here and put this with a negative sign. So these are the future cash inflows. You will see now I've added year 0. That is the amount of the initial investment. And I've put the initial investment as a negative cash flow. So all I've done is added one more row before the first row here, called it year 0, and I put the initial investment as a cash outflow. And now I create another column called cumulative cash flow. So I keep adding up the cash flows. So the cumulative cash flow at the end of year 0 is minus 50. Minus 50 plus 7 becomes minus 43. Minus 43 plus 9 becomes minus 34, and so on. Minus 34 plus 10 becomes minus 24. And basically, the moment it turns positive, I know I have recovered my original investment. Okay, so we have only 10 minutes left. Okay, so I'll have to speed up. Okay, so then the payback period is simply, you recover the money sometime in the 5th year. So the payback period is 4 plus what is left to be recovered divided by what you recovered, and that becomes so the payback period is 4.93 years. So these are the disadvantages. Mukesh, I'll send you the slides so people can read the slides. I'm going to skip now, and I'm going to focus on the more important ones.
Okay. Yeah, that will make sense. Yeah.
So now the method that is theoretically the right method, and what you should be using is called the NPV, or the net present value method. In order to explain that, let me explain to you the concept of present value. So anytime you have a future cash flow, you can figure out what's the value of that future cash flow today. So if the cash flow is in year 1, what is the present value? You simply divide it by 1 plus some interest rate R. What is that interest rate? It is the rate you should be using to find the present value. And in a few minutes, I'll explain what that is. So R is the interest rate at which you should find the present value. It is also called as the discount rate. And present value is also called the discounted cash flow. So present value of a future cash flows is referred to as the discounted cash flow. So let us say the cash flow in year 1 is 7 lakhs. The appropriate R is 12%. You will divide 7 lakhs by 1 plus R, which is 7 divided by 1.12. And so the present value of the 7 lakhs in year 1, present value today is 625,000. So what about the present value of a cash flow in year 2? You simply divide it by 1 plus R twice. Or this should be CF2, my typo. So make this, I'll correct it before sending. So this is CF2. What if the cash flow is in year T? So then this should be CFT. You divide it by 1 plus R to the power T to find the present value. So if CF7 is 18 lakhs and the appropriate R is 12%, its present value today is 18 lakhs divided by 1.12 to the power 7. So that becomes the present value of CF7. Now, for NPV calculation, R is whatever is the required rate of return you as investors shareholders would like to earn. If the shareholders would like to earn 12%, set R to 12%. If the shareholders or the owners want to earn 18%, you set it equal to 18%. Now, what the shareholders want to earn, obviously, I want to earn 80%. That's what the market will allow such a project to earn. What is the minimum acceptable rate of return based on the current market conditions and based on the risk of that project? And we will calculate something called NPV. If that NPV is 0, it means the project is earning exactly the rate of return shareholders want to earn. A positive NPV implies it's earning a higher rate of return than shareholders want to earn. And a negative NPV means it is going to earn less than what the shareholders want to earn. So remember these 7-year project with a 50 lakh investment, and these were the cash flows. If the appropriate R is 12%, I can find the present value of all of these cash flows. So 7 lakhs in year 1 is worth 625 today. 11 lakhs 4 years from now is worth 6.99 lakhs today. 18 lakhs 7 years from now is worth 8.14 lakhs today. You add up all of these and net them out with your initial investment. And the NPV in this case is positive 1.72 lakhs. Since it is positive, you will say accept this project. If this had been exactly 0, it would imply the project earn exactly 12%. Since this is positive, it implies the project is earning more than the required rate of return. So this project is acceptable. If it had been negative, you would have said reject the project. So this is the underlying formula that is being used. You're finding the present value of all the future cash flows and subtracting the initial investment. And that becomes the NPV. Advantages are it considers all cash flows, it takes into account time value of money. I'll send you the slides so you can look over on any of this. However, investors prefer to do something called internal rate of return or IRR. Okay. The internal rate of return or IRR is simply calculating the rate of return that you will earn on the project. So let's take a simple 1-year project. If you invest 10 lakhs today and get back 11 lakhs 1 year from now, what's your rate of return? Obviously, it's 10%. You invested 10 lakhs and you increased your wealth by 1 lakh. So gain divided by investment is 10%. But that becomes very difficult to do when you invest 50 lakhs and you get this much. What's your rate of return? Is it 7 lakhs divided by 50 lakhs? No. Is it 18 lakhs divided by 50 lakhs? No. You are getting all of these cash flows. So whenever you have multiple cash flow streams, this formula for rate of return is no longer valid. So we need to come up with another formula for rate of return. So an alternate way to figure out rate of return is tell me the R that makes the present value of the future cash flow equal to the initial investment. So the new definition of return is what is the rate R that will make the present value of the future cash flows equal to the original investment, which means what R will make the present value of 11 lakhs equal to 10 lakhs. And you will see that is exactly 10%. So this concept of rate of return, calling the rate of return is that R that makes the present value of future cash flows equal to the current investment, is going to be the working definition of rate of return for capital budgeting purpose. Or you can say IRR is that interest rate that makes the NPV 0. So figure out that R that will make the NPV 0, and we will call it the internal rate of return on the project. So these are the cash flows. So I'm going to find the R that makes the NPV 0, or that makes the present value of these cash flows equal to exactly 50 lakhs. So if I make the present value of these cash flows equal to 50 lakhs, my NPV will become 0. Again, I'll send you the slides, okay? But I'll stay back if you want to hang around a little longer. So using trial and error, I keep trying different R's, and this R, 12.920446, makes the NPV 0. What does that mean? It makes the present value of the future cash flows exactly equal to your investment. So round it off to 2 digits after decimal. I'm going to say the IRR of this project is 12.92. Now, how do you implement the rule? If the IRR is greater than your required rate of return, say yes, accept the project. If IRR is less than the required rate of the return, you reject the project. So how do you do this trial and error? You can use Excel. Simply put year 0 through year 7. If the project has 15 years, go year 0 to year 15, put down all the cash flows, and use a function in Excel called IRR, and put in all the cash flows, B2 through B9. So this is simply a screenshot of an Excel. So this is column B. These are rows 2 through 9. So I say IRR B2 to B9, and it does the trial and error for me and tells me that's the IRR. So you don't have to go through this trial and error. Let Excel do it for you. And if IRR is equal to or greater than the required rate of return, you accept the project. If it is less, you reject the project. For a conventional project, NPV and IRR will give you the same accept reject decision. And what is a conventional project? When the sign of the cash flow changes only once. However, for non-conventional projects, IRR becomes completely meaningless. So it's intuitively more appealing than NPV. It gives you the correct accept reject decision. What are the disadvantages of IRR? When you have non-conventional projects, you get multiple IRRs and they're all meaningless numbers. And when you have mutually exclusive projects, IRR gives an incorrect ranking of which is best, which is not the best. NPV gives the correct ranking. I know I've gone over, but that's par for the course. Whenever I teach a class also, I tend to go over. I'll send you these slides. It has the discounted payback period. It's pretty similar to payback period, except you accumulate the present values, and then you have profitability index. And then I was supposed to do Q&A, but I'll stay back if you all want, any of you want to, or any of you want to stay back. And I'm sorry again for going a few minutes over.
No, I think it was very interesting, Raman. So let's check if there are any questions now.
Okay. And sorry for rushing through the second part, but I did want to finish NPV and IRR. Those are the over 80-90% of the firms will use NPV and IRR, both of these methods, for doing capital budgeting.
So Raman sir, we have not considered interest and EBITDA as in that. I mean the depreciation, non-cash profits. Just we have considered the cash flow from EBIT. So where would the interest will take on that?
Okay, so yeah, so that can be another discussion. R is the appropriate rate of return required by the investors. It's a weighted average. It's called the cost of capital. That's how we estimate R. And we didn't get into that, how R is actually estimated. It's the weighted average required rate of return of debt and equity. So let us say money actually in corporation can come from 6 or 7 sources: a bank loan, public issuance of debt, preferred stock, common stock. So let's, just to keep life simple, keep 2 sources. Let us say 60% of the money has come from stockholders and 40% of the money has come from a bank. And the bank requires a 9% interest. So this R will be a weighted average of that 9% that bank requires. And let us say, based on the risk of the project, the stockholders want to earn 17%. So you will take a weighted average of that 17% and 9%. Stockholders want 17%. They provided 60% of the capital. The debt holders provided 40% of the capital. They want to earn 9%. You take a weighted average of the two, and R becomes the weighted average cost of capital. So in those scenarios, R takes into account the interest cost that you're talking about. So EBITDA does not consider interest cost because it's the earnings before interest and taxes. And so, but the cost is incorporated into the required rate of return. And as long as the risk of the new investment is similar to the risk of existing line, let us say Vistara were to add new routes, you would expect the risk involved will be similar to the existing line of business. So you can calculate R as the cost of capital for the current operations of Vistara and use that R as the required rate of return for evaluating new investment opportunities. So you're not ignoring the interest cost. It is being incorporated into your required rate of return that you should be earning. Does that answer your question?
Yeah, thank you.
I think Vineet Mahindru has sent a note. He has a question.
Yeah. So how does free cash flow? It basically, again, there is no legal definition of cash flow. Different companies, different professors, different thinkers have proposed different cash flow definitions. So remember about 30, 40 years back, most people just used earnings instead of cash flows and realized that's a mistake. So the preliminary estimates of cash flow were simply EBITDA. But people soon realized that EBITDA does not take into account the investments the firm has to make. So EBITDA, remember, it's the earnings every year before interest and taxes, but you add back the non-cash expenses like depreciation, amortization. So they said out of this EBITDA, what is already needed to expand, build new factories, have new office buildings, acquire new technology. So all the expenses, capital expenses needed to project that future growth in EBITDA should not be counted as part of the cash flow because it's not available. It's not free. So from EBITDA, they will subtract all capital expenditures that are needed for the future growth of the company. And so from the EBITDA, if you subtract the capital expenditures that the firm has to make in order to grow and survive, then that remaining is called the free cash flow, because not all of the cash flow is free. Some of it is already committed to making future capital expenditures. So if we have gone from earnings to EBITDA to using free cash flow for the purpose of making capital budgeting decisions. So I believe you should not use earnings. I believe you should not use cash flow. I believe you should use, for a growing firm, you should use free cash flow. So that's a very good question, Vineet. More and more proponents are suggesting not to use the cash flow, but to use free cash flow for the purpose of capital budgeting and valuation. But again, how do you estimate cash flow can be a 1.5 hour, 2 hour separate lecture by itself. It's a very complicated exercise to come up with future cash flows and future free cash flows. Does that answer your question, Vineet?
Yes, Professor. Thank you so much.
You're welcome.
Do we have any other questions?
And again, if you have any questions, please forward them to Prashant or to Mukesh, and I'll be glad to answer those questions by email.
Yes.
Or any.
Yeah, I think we'll do that.
So much, sir. Yeah, we'll do that.
That will be good.
But I can wait if somebody has questions. I don't have any commitments for the next 1 hour.
So I think, Abhinaya, what you can do is that for those who want to leave because the time is up, so maybe you can do a formal wrap up and vote of thanks. And then I think, for example, Prashant has got a very interesting question. So maybe some of us who are still wanting to ask questions, because Professor Raman Kumar stays, he can stay back. Maybe they can ask that question. We won't close the Zoom call. Will that be fine, Raman?
Yeah, that's absolutely fine. It's just like my class. At the end of the class, some people stay back, some people leave. So I hang around till.
Yeah, we actually wanted to discuss about the impending recession that we keep hearing about in India and abroad. So I think that's a strategic call most of the CFOs would want to take, how to go through it and what all we can take into consideration while dealing with the situation. So maybe later, I think if somebody has to drop out, they can, for sure. Yeah.
Right. Okay, so thank you so much, Professor, for leaving us with all of this knowledge and not just an enriched finance vocabulary, but also detailing out descriptions so that we know exactly what everything means. And I would like to believe that this is only the beginning of our learning journey from you. And we are very keen to continue our association with you. And with all that we've learned today, we would love to have you back for another very, very relevant session on personal finance and investment strategy.
I'll be glad to do so. That is closer to my heart than this topic is.
I can say it's closer to everybody's heart here, especially the markets seeing a dip every day. Thank you so much, Prashant, Mukesh sir, Jagmeet, for helping organize this session. And thank you so much, panelists, for joining us. I hope you all have a very good evening. Whoever would like to have a chat with Sir can stay back. Rest, you may leave. Thank you so much.
And they can send in their questions in case they would like to even do it later. And we shall pass it on to Professor.
Right.
Right. Okay.
Professor, one relevant question I have in context to the businesses, what we have after COVID. For example, a business enterprise who has just done a long-term capital expenditure in 2019 or 20 initial, and then there's a 2 years of inflation as in a COVID happened. And then the debt what, because the capex for the increase of the capex, there's a debt which has come out. What would be the right mix to handle the debt? Because the 2 years, the cash flow projected was not in that line, which has to be, but the debt has burdened the organization. And what should be the right way of handling it out?
Okay, so let me back up and give you the context how that decision is made about the optimal level of debt and equity in a firm. What percentage of the total capital should be debt and what percentage should be equity? These are the two main sources of capital. Basically, the more debt a firm takes, it's adding to its risk. Whatever. So, okay, let me back up even one more step. Every business comes with certain amount of risk. We call that business risk. That has to do with the volatility of sales. Some lines of business have very small volatility of sales, like electric utility company. And in US, those companies are private companies. So power companies, railroad companies, consumer staples, their sales do not fluctuate much year to year. Their expenses don't fluctuate much year to year, the essential goods. On the other hand, as you go from your needs to wants, cheaper items to more expensive items, as the economy does better or worse, the sales fluctuate more for certain product lines, for certain services. So the business risk is different for different industries. When you take on debt, you're adding to that risk by piling on financial risk on top of business risk. Now, what is the definition of financial risk? The definition of financial risk is now, in addition to the fluctuations caused by changes in business conditions, your earnings and cash flows are going to go up and down. But in addition to that, now you have a fixed commitment to pay interest and principal repayments. And what if your cash flow, because of the fluctuations in the business cycles, drops below what you need to repay the debt and the interest payment? So in that sense, by taking on debt, you are piling on one additional dimension of risk. So you have come pre-packaged with some business risk based on the business line you're in, and now you're taking on more risk by adding on debt. So if your business risk is small, you can afford to take more financial risk. But if your business risk is very high, maybe you should not be taking as much financial risk. However, the reality of the market is such that startups have a very high business risk because depending on whether the idea will succeed or not. And so you already have high business risk. By taking on debt, you're adding on more financial risk. And so the lenders were not that willing to give money, debt money. And that's why we had the need for private equity, venture capital. That is, when the business risk is so high, you don't want to add financial risk. So you bring in more equity. But how do you bring in more equity? You're limited to your family and friends whom you can convince to part with their money and become owners, not lenders. But so the need was there. So the whole concept of private equity, angel capital, venture capital, there was a need out there to provide equity to startups that had huge business risk. So now, given that context, your question is, in the pre-COVID era, some firms made capital expenditure using debt, but then the business conditions unexpectedly turned negative. And now they are stuck with debt. Now, in US, what happens at this stage is that you meet your bankers, you meet your lenders, and renegotiate the terms of the debt. You convince them that you still have a viable business model. That is, your lack of liquidity. So I'm going to introduce two terms, liquidity and solvency. Solvency is when you're long-term insolvent. Your business model is such that you're not going to generate enough earnings, you're not going to generate enough cash flow, even in the best of times, to be able to repay the debt you have taken. We call that insolvency. You become insolvent. Then that business has to be closed down because the long-term future prospects are not enough to pay off the debt of the business. And so basically, the debt holders will have to take over the firm, sell the assets, and collect whatever they can. But even in those cases, reorganizations are possible. The debt holders can become the owners or whatever. There are various ways a firm can be restructured, an insolvent firm. But the situation you are describing is not of insolvency, but of illiquidity. That is, you made the capex assuming certain business conditions temporarily turned bad. But if you can prepare your projected income statement and balance sheet and cash flow showing that the firm is not insolvent, it's just illiquid for the time being, it's temporarily out of cash because of 2 bad years, and those bad years were not because of bad decision making, it's because of an unexpected event called COVID. And now, once the COVID restrictions have been eased, in marketplaces operating well again, you come up with your revised projected income statement, balance sheet, cash flow statements for the next 6-7 years and show that the firm is not insolvent, just illiquid. And within 2 or 3 years, the liquidity problem should go away. So basically, you're asking your lenders to provide you forbearance. That is, can we restructure the repayment, the interest and the principal repayment, so that if we were to close now, you would lose money. But if you stay with me for the next few years, by restructuring the repayments, we will soon we are not insolvent, and we will soon be able to override our liquidity problem, and we will be able to, so give us more time to repay the debt in the interest and the principal. That's called renegotiating a debt contract. And that happens very often. And if you're not able to do it yourself, as a business owner, at least in US, and I'm sure in India also, there are bankruptcy and reorganization companies that will help you renegotiate the debt. Obviously, they'll charge you money for that. And it is my understanding that the bankruptcy code in India till about 7-8 years back was really outdated, and it was very difficult to do this kind of a thing, the reorganization, the renegotiation. But it is my understanding that about 6-7 years ago, the bankruptcy code in India was completely rewritten, making it much easier for businesses to renegotiate the debt terms with the lenders. I'm wondering if I've answered the question you asked, or I went on a completely different tangent.
No, I got that. That restructuring is one of the way that you that when I understood that that's one of the way.
Hmm.
Uh, yeah, I think the initial decision that debt equity mix, how much it would be, that is a crucial decision which has to be taken, and that's financial risk as well as a business risk. That's
Yeah.
always there to be there.
Yeah. And basically you are moving away from your optimal debt mix quite often because equity is simply not available. So optimal mix is optimal if you can achieve it. If you can't, you have to accept the second best solution.
Yeah.
And you may be significantly away from the optimal, but I would still suggest to the firm, if the lender is not a bank, if the lender is a family friend, ask them that are they willing to turn their loan into equity. That is, I'm willing to give you 10% of the ownership of the firm, and instead of being a lender, become a part owner of the firm with me. And in US, a lot of lenders will turn into owners if the market conditions are such that they cannot collect the money. So yes, I'm willing to give you forbearance, but now make me an owner. And at that point, it is both in your interest as well as the interest of the lender because the more debt you take, the more risk you are undertaking going forward, financial risk. And the lender now is saying, my claim is becoming riskier and riskier. It seems as if I'm the owner. So why not give me 10% of the stake in the firm? And I'll be willing to turn. So a lot of lenders, early stage lenders, are willing to become owners if the firm hits into bad time. In fact, they may put it into the debt contract. If you are unable to make the interest payment at the promised date, my debt will turn into equity. Now, I know the markets, financial markets, and the borrow lenders and equity providers are a lot more advanced over the years and have evolved into a much more sophisticated level. But somebody has to begin that process in India, and you should be negotiating with your lenders, especially if they are family and friends. Are they willing to become part owners? And their debt will turn into equity.
Yeah. Thank you. Thank you very much. Yeah.
You're welcome. If there are any more questions, I can stay around. Otherwise, we can sign off.
Yes, sir. If I'll get any questions on my email ID, I'll drop it to you for any questions from your side.
Yeah, be glad to answer them.
Sure. Thank you so much, sir.
Yeah. So Raman, here is a second vote of thanks. The first one was given by Abhinaya. The second one is that really it was absolutely engrossing, and I'm sure most of our participants are very, very happy with the kind of inputs they have got. And yeah, like Praveen says, it was amazing. So it was actually amazing. And I got some comments. I got some comments from a few others saying that you are an excellent teacher. Right? So which is anyway a fact, statement of fact.
Thank you. Thank you.
So two things. One is that, of course, we'll pass on some questions which will come to Prashant on his email ID. And second is, of course, maybe it's already about 2 hours now. So I would like to have, along with a few of my colleagues, have a quick conference call with you on any of the days, maybe tomorrow or something, at a mutually convenient time, so we can quickly share some more details about what kind of feedback we have and what we would like to get from you in future, because all of us are really looking forward to having you back, and talk about something which is more interesting to you and more interesting to our participants, which is in the area of investment.
Yeah, be glad to do so. That part, this took me some time to prepare because I don't give talks on corporate finance and CFO very often. I do teach this material in a class setting, but But on the investment side, I've given enough talks, so I could cannibalize some of my old PowerPoints also.
Okay.
Yeah.
And one learning from today is that I think we definitely will have the next session, which will be scheduled to be a little longer, because 1
Yeah.
hour. Is,
Yeah. I tend to be a little long-winded. I don't like short answers. So,
Right.
so
I'm sure your classes there also would be of about 2 hours, or they are 1 hour classes.
the class sessions are twice. Each course meets twice a week, 1 hour, 15 minutes.
Okay.
But one of the common complaints students have, I always go over. So, but whatever other professors can teach in an hour, it takes me 1.5 hours. So, yeah, I tend to be.
The takeaway is worth a couple of tens of hours, I must say. I mean, it's personally for me, it's been one of the most, I think one of my best finance classes, and in a very long time. So while corporate finance may not be your favorite subject, but I think you're really good at it. So
Thank you so much. That makes my day. It makes all the effort I put into preparing this absolutely worthwhile. But
All right, fine, great. Thank you so much, Raman. Thank you.
Take care, Mukesh, and thanks for the opportunity. I enjoy doing this, so I'm glad I was able to do it.
Thank you. Thank you so much.
Thank you.
Take care. Bye bye.
Bye bye.
Good night, everyone.
Right.
Good night.